good evening, afternoon. It's evening for me. Uh, Ken Creager from Black Swan Financial Advisors. The Fed raised interest rates a quarter point yesterday. Um, so it looks like I'm streaming, and that's great. So I wanted to, I was thinking a little bit about this. I wanted to provide a little bit more detail about options trading and the truth about options and some really basic stuff. You'll find this video as part of my free video series on options trading, but it's also going to be part of my advanced options video series that for a small fee you can purchase this advanced course, and it will give you an opportunity to get more in-depth, detailed training and information about options and how to use options. And I do live trades. I do trades over time on the same position, so you can see how options might be used, how you might use them. And I think more importantly is that options can be a little bit complicated and intimidating when you first start out. But the thing is too is their leverage, and if you make a mistake, I made some mistakes when I first started out, and I can guarantee you that the minimal fee that you'll pay for the advanced options course, and you can watch those videos over and over and over again, and you can have the video right there when you're doing your own trades to make sure that you do them properly, because I've made small mistakes that have cost me much more than the minimal cost of that course that I want a really affordable, valuable course that anybody can use. I don't want to charge thousands and thousands of dollars, so it's not very much, and it will more than pay for itself for sure. All my videos are for educational purposes only, and Black Swan Financial Advisors, please subscribe to my YouTube channel. Send me an email if you would like. That would be great. So just a little bit about the truth about stock options. So options are a derivative of the stocks or index funds or exchange traded funds themselves. So they mirror the price movement of a stock option mirrors the price movement of the stock, but it's leveraged, right? One options contract controls 100 shares, so they're leveraged, but they trade alongside stocks and funds on the major exchanges. But the stock options are going to be a little bit less liquid than the stocks themselves, and I don't like trading options on thinly traded stocks, because in fact a lot of stocks don't have options at all, but if the stocks are not very active and not highly traded and they do have options, they're going to have not very many options choices, and the expiration dates on those will be months apart. And so I really just like to use options on very actively traded stocks and ETFs and stuff. So you can buy stock and you can buy the options, the index option, from any of your brokers. Same, if you use E-Trade or Charles Schwab or whatever, you can buy the options. Now you're going to have to get premium, higher level privileges to do stock options, but you can do that, and the price that you pay for the option is called a premium. And so you can price premium it, but it's a premium, and it fluctuates just like the stock or the index does. So if you buy one, 2 seconds later it can be higher or lower than the price or the premium that you paid for it. Or if you sell it, it can be higher or lower, right after, just like the stock. But again, they're leveraged, and so usually the price movements in the options is a lot greater than in the stock. So for example, the stock might move 2%, but the option might move 20 or 30% with a 2% movement in the stock price, right? It's one of the reasons that they were used for risk management, is that, and like an options on cattle or whatever, and the rancher would buy an option to be able to sell the cattle at a certain price, and they wanted, it's a derivative, and they didn't want to spend all their money, so for a relatively small fee, they can buy what would it be, a put option to sell cattle at a certain price, and they'll give up some of their profit, right? That they do it, but if the price of cattle crashed right when they needed to sell it, they can exercise their put option. And the futures, it's very similar. Futures and options are very similar. So two key factors that determine the price or the premium at any given moment: the strike price, which is the price. So a stock has a current price, and an option has what's called a strike price, which is the price at which the option can be exercised. So for example, the stock might be trading for $100, but you buy an option that has a strike price of $90. And that means that you would buy or sell 100 shares of that particular stock at $90, not at $100. Okay, so that, and the expiration date, time value, options have time value. The strike price is a fixed dollar amount that represents the price the underlying stock or option could hit. So the price goes up and down, and that strike price, whether or not your option has value depends on the strike price's relationship to the actual underlying stock, or the underlying price. So every move of the underlying stock brings it closer or further away from the strike price, and that will change the price of the premium. The expiration date is the final day that the stock's price is compared to the option strike price, and after that it will expire worthless if you don't exercise it or sell it. So options are only good up to a certain period of time, the expiration date. Okay, the closer you get to the expiration date, the more value it loses. Okay, so there's two parts to the value of an option, what's called an intrinsic value. So if your strike price is 90 and the stock current price is 100, the intrinsic value is $10 per share. Now, the option itself, maybe you had to pay $12 for it. Well, that means there's $2 worth of time value, because maybe that option is good for 2 months. Okay, and there are two types of options: puts and calls. A call option's price rises when the underlying stock price rises, and a put option's price rises when the underlying stock price falls. So calls they're bullish, or they're betting on the price going up, and puts are betting on the price going down. So let's talk about call options in action a little bit, and rising prices. Okay, so you would use a call option if you think prices are going to go up. And the thing is that you can get into a trade on something you think is going to go up by buying an option a lot cheaper than if you bought the stock itself, especially if the stocks are expensive, like Costco or something like that, or actually it's Microsoft over $300 now. So to buy even just 10 shares would cost you $3,000. Well, you might be able to get into a Microsoft call option if you think it's going to go up, and get one option that controls 100 shares, and maybe for hundreds of dollars instead of thousands of dollars. So anyway, the price is constantly in motion. It's rising, it's falling, it's going up and down. People are buying and selling the stocks. and we're using Home Depot as an example, well, people buy and sell the options too, okay? So anyone who thinks that Home Depot's stock price is going to go higher, they will buy call options. And actually you can see, you can look at the volume of call options and put options and how much they're trading, and they're kind of a bullish or a bearish indicator. When people are excited about the market or the stock or whatever, you'll see the volume or the amount of call options that people are buying go way up. So let's say that current price is around 95 and you want to buy an option for a $95 strike price. So what that means is you're buying an at-the-money call option. It has no intrinsic value at all, okay? It lacks intrinsic value because if you sold it, I mean, if you exercised it, you would only get 95, you know, you'd have to pay 95 and you only get 95. So what that means is that the stock options that you get into where they're at the money, they don't have any intrinsic value, okay? Now, say for example that the price, you know, for this stock option that you bought with a $95 strike price, the price of the underlying has to go up, right? It has to go up. So it has to rise up above whatever your strike price is before it's worth any money, okay? So you can actually also, some people will buy a more speculative call option that's out of the money. So maybe the current price is $95 and they buy one for 100 because they think it's going to go to 110, say. Well, that's an out of the money option because now the price actually has to move above 100 before your option even gets any intrinsic value again. But the thing is that's cheaper, right? Because you're giving up some of the possible gain, the difference between 95 and 100. So it's cheaper, but you have to have a bigger upward move. So if you buy options, and some of my other videos talk about selling options, which is less risky, okay? And I sell options to get into like a position with Home Depot. I could sell an option to get into it. Most options expire worthless, and if you buy the option, you have to be correct in the direction of the movement. Like a call option, you have to be right that the price goes up, and if you buy a put, you have to be right that the price will go down, and you have to be right in terms of timing. So if you buy an option that expires in 2 months, not only does it have to go in the direction that you think it will go, but it has to do it within 2 months. And so as a seller of an option, you just have to be right in the direction that you think it will go, or it stays the same. And time is your friend, actually. If it expires worthless, then you keep all the money. So anyway, people can buy options with no intrinsic value because of that expiration date, right? Now, there's a different way to do call options where you have some value, and we kind of talked about that a little bit, where instead of buying at the money or out of the money options with no intrinsic value, you can buy options that start out having intrinsic value. So again, say the Home Depot is at 95, well, you can buy a call option with a $90 strike price, and it has $5 of intrinsic value. So these are options that are in the money, and it has intrinsic value. Now they're more expensive because, again, this is worth $5 right from the beginning, and then there's some time value. So maybe the option with a strike price of 95, where the price is exactly the same, costs $2. Well, if you bought the $90 strike price with the $5 of intrinsic value, that's going to cost $7. $7 per share. So anyway, but the thing is, if you buy in the money options, then you have some built-in downside protection, right? It has more than just the time value. Um, so anyway, um, you know, in this particular case, if I bought a call option for $90 and the Home Depot's price would have to fall below the strike price, before it doesn't have any value. Okay, so let's talk about puts for just a second. Put options for falling stocks. Again, maybe I use this to hedge my portfolio. So sometimes I'll buy puts on an ETF. I like to use an ETF like a triple leveraged S&P 500 ETF, and maybe I'll buy a couple of puts. So if my portfolio is run up, and instead of selling my positions and locking in the profit, is maybe I'll buy some put options to hedge my portfolio. But they work the same way, where you have at the money options that don't have any intrinsic value. And again, but puts are for falling prices, right? So if you have a $95 strike price, for your put to be worth money, have intrinsic value, it would have to fall below 95, okay? But you can start out by buying a put that's in the money. So again, maybe current price is 95, but you buy a $90 strike put and you already have $5 of intrinsic value. Okay, and so I used to mostly deal with like at the money options, or maybe slightly away and actually out of the money options because they're cheaper. But I'm doing a few trades where I'm purchasing. They're kind of speculative trades. I'm purchasing and I'm betting for the call options. I'm betting that prices go up, and for the put options that they go down. And I am buying in the money options that have intrinsic value in the beginning. So that way, if the price moves a little bit, then my options still have value. So anyway, just to kind of get into this, this video is getting kind of long, so I want to get into some really important stuff. This is where you can get in trouble, and it's kind of tricky because you have puts and calls. So it's like with the stock or an ETF, you just have one thing that you can buy or sell. But now you have two things. You have a put, which is based on the downward movement of it, and then you have a call. So when you want to get into the trade, and this is important for you to learn this, and again, like I would recommend that you go ahead and subscribe and get into my advanced options course, because then you can see how you do this. But you need to pay attention, because if you do it backwards or wrong, you can lose money pretty quickly. So remember, you can be the buyer or the seller, okay? But if you want to open a position, or you want to get into the position, or you want to start a trade, you open the trade. And then once you're in a position and you want to get out of it, you close the trade, okay? So the first thing you have to understand is, are you opening a new position, or are you going to close an existing one? And then you decide whether you're going to buy or sell based on what you did before, okay? So we'll go on to the next page to give you an example. So a new position. So you want to buy or own a call or a put. You're the buyer, okay? And this is a new position, and you don't own a call or a put, right? You want to buy one. So you open, again, we're opening the trade, opening the contract, and I'm going to buy it, okay? So this is if you're the buyer, okay? You're the buyer right there. You're the buyer. Now, you can also be the seller, And you're opening the contract though. You're getting into this position. So remember, if you're getting into a new position, you're going to open it. Okay, so you either buy to open if you want to be the owner or the buyer, or you sell the open if you're going to sell it to somebody else. So that's to start a new position, you open it. Okay, and now what do you do if once you get into a position? So say I bought to open a call on Home Depot, right? And so I own this call, and it's been going up in value, and now it's worth a lot of money, and I want to sell it and get into my profit. So the first thing you need to remember is you're going to close it, okay? Because you opened it and it's still open, and now I need to close it. It's contract, okay? You open the contract, now you're going to close the contract. So if you bought before, you're going to do the exact opposite of what you did to get into the position. So if you did buy to own, like up here, buy to own, you're going to sell to close it. And then if you were the seller before, where you did a sell to open, you're going to buy to close. So you're just going to do the opposite of what you did to get into the position. And like I said, I've made this mistake before, and or I mess up the strike price or the expiration. And probably that's the biggest thing is I'm looking at the options chain, and I'm looking at different expirations, and I think I was in one that was, say, a month out, and then I execute the trade and I find out, well, I just bought or sold an options contract that expires on Friday, right? And so then I need to get out of it, and in the meantime it's lost money and I lose money. So I remember when I first started learning options, and I was just learning the hard way, that thankfully I didn't make a lot of mistakes, and I started out small. So you do want to start out small, but man, I sure wish I had some videos watching people do real trades so that I could watch it as I did my own trades until I could learn how to do it properly. So anyway, thanks for tuning in. I hope that was valuable. And my advanced options course is going to be available shortly, or depending on when you watch this video, it might already be available. So I would encourage you maybe to, for the minimal fee, is to go get that so that you have access to that, and you'll have access to it forever. So thank you again. The video has been for educational purposes only. Please subscribe to my